Let's take another look at our ag commodity trade here on a Thursday. And again, I'll remind you, we did not have weekly export sales data out this morning because Tuesday was a holiday. So we're going to get those numbers tomorrow morning. Just a little footnote there. Now let's go back to our prices. We had everything trading all over the place this morning. And well, one thing that had been jockeying around for a position was corn. And now it has been firming up here this morning. We currently have that September contract now trading 7.5 higher. We're at 492 3/4. And you have December up 6.5 this morning. We're right at exactly $5 per bushel. Now on the soybeans, they have been bouncing around higher, lower, and now they're on the downside. You have August down 10 cents. We're at 14.58 3/4, and November now down 11 1/4 at 13.44. Make it 11 lower now, and that's 20. No, it's not 20. It's about 18 cents off of its overnight high. We're about a nickel or so from our low of the day right now on that November contract. And then you get to the wheat, and wheat, it had a strange market action overnight on itself. You had Chicago going lower overnight, but Kansas City and Minneapolis were fairly moderately higher, if not sharply higher. Well, right now, Chicago September is down 19 3/4 cents at 654.5. If you look at Kansas City, which had been much higher overnight, now we have September down 11 1/4. We're at 8.35 per bushel. And if we take a look at the Minneapolis market here so far this morning, we currently have the September down 4 at 8.53.5 per bushel. And I want to check in on the cotton market as well. We'll see what that December contract is doing. It's currently down 20 points. We're at 80.03 per pound. We have Chris Swift on the line with us. He is with Swift Trading Incorporated. He is based in Nashville with Swift Trading. Let's talk about this, Chris. The market's going different directions here today, and it's kind of hard to keep good tabs on what they are actually trying to tell us. So what's your best take on it anyway? Are we just biding our time here?
Well, you've seen car wrecks happen on the interstate where cars are moving really fast and one tries to avoid the other and puts them in total chaos, and you start to see cars spinning around everywhere. That's what these markets are doing.
Is that what
we got information on Friday that was so out of line with context of what we believed was going to be, as well as missing those numbers by such a significant amount, it just makes you question, is something wrong there? So markets overreacted, in my opinion. They're going to continue to overreact, but more likely than not, with the ranges built, especially in corn, you just start to see some consolidation. We've been just a little bit under 5. We might go back just a little over 5.50 and then just continue to trade in that range until we get further information. And that's what the market is really going to want, is that further information. July 12th is probably going to be the first that we get. We'll get a yield basis off of that, and then we begin to see if there's any kind of readjustments in those acres numbers.
Let's look at a December corn chart here. And now, given the fact that we had that big move a while back and then that sharp fall after that, have you readjusted your targets on where you're willing to pull the trigger if you want to market new crop corn right now? Are you going to be satisfied with taking less now?
I think you might have to if you're going to really look at marketing right now. I don't know that I would really want to market physically a lot right here. I might turn to the options market and give myself some options 4 to 6 weeks from now. If I'm really not liking the price right here, but it may continue to go down, own some short-dated put options. Something that's going to keep you from just watching this thing melt and you not making anything. In the interim, you spend some change on the option and the market trades back up to 550, 560. That's great. Now I can take and actually physically market some inventory there. If not, I still got to take the low end of it, but I've got those put options that have at least helped a little bit on the way down.
Now, what about if I switch the chart to December of next year, 24 corn? It's at $5.75. It's a penny and 3/4 higher today. We're just above the $5 threshold. Is that tempting or not?
Well, from a cash standpoint, yes, probably so. From an option standpoint, the premium that you pay for the option eats up a lot of whatever potential that you may have here.
Sure.
So, here at $5 a bushel, and already seeing we grew an enormous amount of corn this year, but Are we going to go in if this produces lower prices this year? Will that be encouraging to raise more corn again next year, or do we swap back the rotation to more soybeans significantly at a higher price?
Oh boy, that's some big decisions that producers have to make this
easy,
year.
I'll tell you, it's really not.
You bet. All right. Well, I'll tell you what, we'll take a quick break, and Chris will come back, and I want to get your thoughts on our livestock trade on the other side. All right, we're back, and we're going to take a look now at our livestock trade, beginning, as usual, with live cattle futures. The quotes are provided by Bar Chart. On the live cattle board, I see a lot of down arrows all across that board. The August contract down 70 cents at 174.25 right now. You have the October down 52 at 177.35. That is actually 20 cents from its high of the day, though. We're about 70 cents off our earlier low. So things kind of drifting toward the upper end of our trading range today on the live cattle. They had been over $1 lower there at one point. Now on the feeders, yeah, they've still got a lot of pressure. August down 252 now at 242.17 after a high of 243.92. So caution flags are still out there. September down $2.50 at 245.65. On the lean hogs, remember they had a big higher close yesterday and they have a higher trade again this morning. You have August now up $3.10 at $100.55. There you have it. They rang the bell. Last time we looked, they were at 99.75, I believe. Well, now they added on another dollar. They got as high as $100.75. So huge gains in the lean hogs, and it looks like they're running wild today, Chris.
They are, and probably some good reason, too. We've seen beef prices really high in the grocery store, and pork prices have been really inexpensive. So we know that we've still got inflation going on, the consumer a little bit strapped. So I can see clearly where we're trying to lean a little bit towards a different alternative meat protein.
Well, I noticed on the pork cutout values that we had yesterday, they had taken a big jump in the pork belly prices. When you look at the primal cuts out there, they had gone up sharply here over the past couple of days. A lot of times you think that, well, maybe it's a one-off. You know, they had gotten down to well under $100 there for a while, but tell you what, that looks like it's staying up there high enough, long enough that it probably will have an impact at the retail market, won't it?
Oh, absolutely. And of course, it's a seasonal tendency as well. The bacon, lettuce, and tomato sandwich, we talked about that earlier this week. And just that particular seasonal aspect tends to put, and another, the feature. So the hamburger places, the fast food restaurants tend to feature bacon on their burgers during the summer like that. So I think that is a big difference in the demand for the bellies right now.
Okay, well, if you look at the live cattle trade, tell you what, I tried to help out the market. We had ribeyes over the weekend here in the holiday break. And they were excellent, by the way. But have they maybe formed a longer-term top, do you think, or not?
Well, it sure seems like it. You know, we've literally doubled the price in both fats and feeders over the last 2 years, 3 years. April of 20 is when we bottomed here. And I think we're going to see some discrepancies. I think we'll see the fat market kind of stay firm in here because we know we don't have a little bit lower amount of fat cattle on feed here. But the feeder cattle market has been hinged on the corn. And the anticipation of a lower feed cost going forward, and although we are lower than off the highs there, we're still not at the $4 level where a lot of these feeder cattle are believed priced on a cost of gain basis. So I think we've got some downside in the feeder cattle market. Yesterday put in a very ominous outside reversal day where you gapped higher, traded higher, and closed on the low of the day, creating a contract high across the board. So we gapped lower this morning. We've yet to fill the gap. We may try to fill it, but I think this should be a good warning sign to a lot of those cattle feeders out here, and especially the backgrounders that are looking to market over these next 4 weeks in these big video sales, that it might not be as good as what we kind of had thought it would be all year long.
Yep.
We pushed the price up all year long. So,
yeah, good advice. Just be alert and be wary out there. So pay attention. Thank you very much, Chris, for joining us. Chris Swift of Swift Trading in Nashville with us here on a very busy Thursday morning.